Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this video on how to effectively trade in ranges using supply and demand. And the reason why I'm making this video is because it was from a question from David Lopez, who said, "Thank you. If it's not too much trouble, would you be able to make a video on how to effectively trade in ranges, in trading ranges? Some markets have been extremely choppy lately, and I've heard countless times that there is no edge or price action, is usually random in these conditions, but yet there are traders who are making money on a consistent basis in these types of conditions. If you could, that would be immensely valuable and helpful, as this is an area in where I struggle with at Trading 180. So today's this video is going to be about trading effectively in ranges, and everything comes down to supply and demand. So I'm going to go through the process and what I do, and pretty much how everything relates to supply and demand. So we're going to go through these 7 things. So first is time frame. I will look at what the market state is on a daily and weekly time frame chart. The higher time frame charts is what I will look at, right? I'm not looking at the intraday market states, and it's really because all traders, whether you're an intraday trader or not, will look at the daily time frame chart. Daily time frame traders won't look at intraday time frame charts. So there's more supply on, more eyes and more supply and demand on a daily. It's more significant, basically. A daily time frame chart, and weeklies can be as well, right? Even though weeklies have a bit of a you're not getting maybe as much trades, because obviously you've got to wait for the weekly candle to close. So daily is pretty much a universal time frame, and for me it's the most significant time frame in order to establish whether the market is in a range or whether it's in what people would call a trend: higher highs, higher lows, lower highs, and lower lows, right? So first of all is establish your time frame. The next thing you have to do, which is absolutely critical, and I know a lot of traders, they're turned off by this, but you have to establish value via fundamentals and also sentiment. But you've established value via fundamentals. And why is this important? This is important because you cannot establish value, true value, whether something is cheap or at a bargain price, just using technical analysis. Every commodity, currency, whatever it is that you're trading has, is determined by value. So stocks are determined by, maybe balance sheet, PE ratio, price to earnings ratio, etc. Right? You have commodities that are governed by supply and demand. For example, oil is a finite commodity, and so depending on how much barrels are produced every week, according to and how many rigs are actually constructed as well or not constructed that week, will determine the supply and demand equation. If there's more supply, if there's an oversupply of barrels, not enough demand, then what do you think is going to happen? Price is going to go down. If there's not enough oil and there's a lot of demand and there's not enough barrels to meet that demand, then prices are going to go higher, right? But the point being is that currencies are also governed by fundamental principles. So those being interest rates, right? Interest rates and inflation. So IR, interest rates and inflation, right? Inflation is basically prices, and then you've also got a country's GDP, right? GDP. So what you want to look at in overall terms, and I'm not going to get too much into this, maybe a minute or so, but what you want to do is establish whether a country has rising inflation, therefore are looking to raise interest rates, right, and also have growing GDP, that would indicate a strong currency. That's one to buy. If you have falling inflation, right, therefore you're going to have interest rate cuts, and on top of that, GDP is falling. In fact, you should really look at GDP first and then the rest of that. But, just as an overall picture, this is the one you want to be selling, right? And as currencies are traded in pairs, right? So EU, GU, etc. Euro, dollar, right? You're looking for, if this is, if the euro is struggling with inflation and GDP, and the dollar is, growing in GDP and inflation and raising interest rates, you should expect a trending market. What you want to, I wouldn't say stay away from, but what you want to be aware is what causes trending and what causes ranging markets, right? But you have to establish that through fundamentals. Fundamental analysis is an absolute must. So causes of ranging market states, and this is what I was kind of alluding to before, just concluding that. Now, causes of ranging market states: price acceptance and bank iceberg orders, which is accumulation. So price acceptance. So you have, let me just go back a little bit. So you've got price acceptance, which is, if we're on a price chart, and this is price, and this is obviously time, right? The market's moving sideways. It means that prices have been accepted between, a figure there and a number there, right? Price acceptance. Buyers or sellers, because we trade in, obviously, pairs, something against the other. With stocks, it's different, where you just got pretty much, the stock or whatever it is. But let's say, for example, this is either going to be an expensive, right, or a cheap level, depending on what, you're buying. And what I mean by that is, obviously buyers and sellers are in agreement that they don't want to push the prices higher. And then obviously prices can't go lower here. So this is going to be also an expensive, or a cheap level, depending on, whether you're buying or selling, right? But this is what you would call price acceptance between a range, right? And normally that happens because you've got maybe two competing currencies, and people and traders and investors don't know which one would be the stronger currency. If you've got two strong currencies or two weak currencies competing against each other, how do investors and traders know which one is the one to buy? You don't. So you have mixed views. So prices tend to end up in a range fundamentally, right? Until, something changes, a catalyst changes, maybe an interest rate hike or an interest rate cut. And then what happens is you get a trending market, which is known as price discovery, because price is discovering where, buyers and sellers are going to be in agreement again, acceptance as to where price is going to range again, where the value is, right? Between maybe, that price and that price. So that's what we term price acceptance, right? That's what ranges are. Buyers and sellers are in agreement, right? And this would be fair value in between, highs and lows, right? Fair value. Now, bank and iceberg orders is something we're not going to necessarily cover. I've covered it in another video, but pretty much what is happening during a ranging market is banks will also accumulate, right, through what is known as iceberg orders. And what iceberg orders are is basically banks will have a large order, and due to slippage and liquidity, they have to basically divide up their massive order into pieces and then add, right, into what would be known as a ranging market to disguise their true intentions of what they want to buy or what they want to sell, right? But that goes beyond what we're talking about here. But those are the two reasons why, the causes of ranging markets, right? The banks will manipulate the market to confuse traders. Everyone screams trend, and they can disguise their iceberg orders within ranging markets and then push the market to where they want to, where it wants to go. So those are the two reasons and causes for ranging market states. Now, even if you're trading a strong currency versus a weak currency, you can still get obviously ranging market states because of, the iceberg orders and manipulation, right? Accumulation, manipulation of the market within the ranging market state. The bank wants to be, or financial institutions want to be buyers, right? But if everybody else wants to be a buyer, then they have to use ranging market states for, maybe a couple of days. It could be a couple of weeks, right? Before they can accumulate all of their buy orders, right? Because in the ranging market states, there's going to be likely to be sell orders. If you're in a trending market, there's going to be less likely to be sell orders unless you're doing, stop losses below here and stop hunts, but then that gets into something else. But so those are the causes of ranging markets, right? Now, the definition, right, of a ranging market is 2 touches of a level. So what you want to see is, you'll probably see something like this. Maybe prices will be trending, right? Lower lows, lower highs. And then what you'll see is a touch of a level, another touch of a level. And as soon as prices do something like this will start to come up, right? This now starts to look like a ranging market, right? And then obviously you get, third touches. Now, for me, this is a level of supply. So I'm always trying to get in at levels of supply. So this is where I would be looking to sell if I thought that this was a good buying opportunity. And what I mean by that is, let's say, for example, I wanted to be, and I am currently a buyer of the dollar, right? Buyer of the dollar. In order for me to buy the dollar, I need to press sell on my broker platform. In order to buy the dollar on this currency pair. So it will be a supply order right here. So the definition of a range is 2 touches of a level, right? So most support and resistance traders will probably look at this as the first, or the second touch of a level. I would look at this area here as a definite interest. If this was the original supply, right, then I'd be looking at this level to get in first, and then this would be the second touch of a level, right? So this is how we get into ranges. When you say to trade ranges effectively, right, this is one of the ways that you can do it with supply and demand, is because you're getting in ahead of other traders who will look at this, and once price action starts to look at that, that's when they consider that to be, oh, now we're in a ranging market, right? But ranges can start actually from lower highs and higher lows. So this is where, if you're trading supply and demand, right, this is where you will be buying, and this is where everyone else is buying, right, who trades support and resistance. And again, depending on obviously what happened to the left, because you might have something like this. So you'd have support and resistance traders. If that was obviously support, this ends up being resistance here, so then they'll be getting in here. But if you didn't have an obvious level of support turning into resistance, then this would be where everyone else would be getting in. But either way, we're getting in here regardless of what happens to the left of the chart, right? So when you say what effectively, because let me go back a bit, if prices are going to range from somewhere, right, and I'll show you this on the price chart. Prices are either going to range from here, from here, from here, yeah, or they're going to range from levels of support and resistance. So imagine this was a level of support turned previous resistance. Prices are going to range from here, right? Or they might range from here, like that, So it's vitally important that you actually decide, and it's why we come back to establishing value, what direction you want to trade. Because if you don't know what direction and what you're buying at value, right, and potential bargain, then you have no idea what you should really, or how to anticipate, ranges. And ranges again occur from either support or resistance or supply and demand levels, but I would look for supply and demand levels as being the strongest levels, as they represent true potential value. This is not potential value at all. This would be maybe some sort of retracement back to maybe the 50% or 61% discount. This would be the 100% discount if you know about Fibonacci, right? This is where you really want to be looking for a buy trade. So let me just go back a sec. So hopefully that made a bit of sense, but let's go back to here. So we expect ranges, and the definition of ranges are two touches of a level, so an obvious level, right? That being said, so before hindsight bias, expecting ranges before they happen. So I did cover that, matter of fact. So again, I'm always expecting a range to happen at a level of supply or at a level of demand, right? I'm always expecting a level of prices to range at a demand zone, right? Or at least bounce off of that area, right? Because what we're trying to do is buy, as I said, at value, right? That would be value. That'd be a nice demand zone. Prices come back down into here. This is where we want to be buyers, right? So always expect, and if it's demand, this would be supply. This is deemed as a cheap, right, or bargain area, and this would be expensive. Why is it expensive? Right, if we're looking to be buyers, I've done a fundamental analysis, and demand can't push prices past this value, whatever this value is here, at this level, then this is obviously an expensive area. Buyers don't want to get in and push prices higher, right? But this is obviously where buyers got in and pushed prices higher. So this is demand. So I'm always expecting prices to at least range, right, from a demand zone. And whether that demand zone comes here, or whether it was, if that was the lower high, lower higher low, higher high, and that was demand zone, right? If this one fails, right, let's say for example you have a level that comes down and that doesn't hold anymore, the more times the level of demand is touched, the weaker it becomes, right? And then go down to the next level, right? Price doesn't always indicate value, and value doesn't always indicate the price, right? People know the cost of everything, but the value of nothing. Yeah, this is what we're concentrating on. Is not looking at price. We're understanding what goes on beyond the price chart, and we're understanding value through fundamentals. So just because prices are going down doesn't mean that it's not valuable. We're buying it for a cheaper price. So going back to the ranging market, this would be the absolute highs, and then we could see prices obviously range from here to here, right? From this expensive level to the cheap level. If prices can't break past this expensive level and prices start breaking down from this demand zone, then what I'm expecting is prices to do an even bigger range, right? Prices might range in between if I'm right about value. If this is a level of demand and it's a bargain area, it's a cheap area, and I've done my fundamental analysis, then I'm buying at a cheap area. And again, this is proven to be maybe an expensive area, and we could get an even bigger move to the upside, right? I'm not worried about trends. I'm worried about value. Trend traders, counter trend traders, my feelings on that are kind of mixed. Trends are great if you're buying at the lows, right? And if you're buying at demand, or you're always buying at value, you're always going to be at the beginning and buying at the beginning of a potential trend, especially as markets trend within ranging markets. So on a lower time frame, this might be the daily time frame, but on maybe an hourly time frame, right, you might get in here risking maybe 20 pips or so, but on the daily time frame, this is maybe part of the daily time frame range, and that's how you kind of use, time frame analysis on your trades, right? So I'm always expecting price to range somewhere, whether it's from here in this level, right, between here and here. And if prices break down and I still want to be a buyer, then I'm expecting prices to range from here, to here and so on and so forth, right? As long as my fundamental analysis, is correct. So, once ranges, expecting ranges before they happen, I've covered that. And now, once ranges are clear for everyone to see, stop hunts, right? So this comes into maybe the second way and how to really kind of trade ranges effectively. And what you really want to do, to everyone watching this, and David, is try to trade at highs or lows, and obvious highs and obvious lows. It's not, again, that's why I choose daily time frame charts. It's difficult the lower time frame you go, because if you're trading 5-minute ranges, is that really significant? If you're trading half an hour or hourly ranges, is that really significant? Daily ranges are more significant, right, than the lower time frame. So I'm always looking at one time frame, the daily time frame, and I'm looking at obvious highs and obvious lows. Yeah, so that's where you want to look to place your trades, right? If you've established a range, right? Now, what is common when you get ranges is what is known as stop hunts. So when we have a range, what tends to happen is a accumulation of, stops will accumulate, yeah, and stops will accumulate. Now, for argument's sake, let's say, we go back to, the bank iceberg orders being accumulation. Let's say we enter into a range and the bank wants to be a buyer, right? It needs sell orders. This is the liquidity that it needs. So sorry, I'm on a trackpad at the moment and my fingers are cramping up. So it needs sell orders. So what happens is, in a ranging market, like I explained before, you're going to get less sell orders in a trending market, and it's going to cause the bank to the bank wants to avoid slippage, so it needs liquidity within the market, right? So what tends to happen is, when you have a ranging market like this and an obvious range, there are stop losses below obvious levels of support, right? Or where price is being supported. Now, if a bank wants to be a buyer, it needs sell orders. So what happens is what you might see is something like this happen, where traders will look to the past and see prices bounced once, twice. Oh, we're in a ranging market, because definition of a range is 2 touches of a level. And then you start to get price action, right, which is bait, which is known as entry cheese and bait, right? If you see a nice pin bar or an engulfing candle to the upside, what are you going to do? Press buy. What is your stop loss? A sell order, right? And this is the liquidity that banks need to be buyers, right? So what they would do is they would trigger your stop losses, stopping you out, right? Transfer of wealth goes from the seller to the buyer, yeah? And then they will move prices in the direction that they want to move the prices. So if you see a range, yeah, if you see prices are in an obvious range, and then you see something like this happen, where you see prices move higher, just enough to get traders interested in buying, right? Or selling, obviously, from the downside, but buying here, but it doesn't quite follow through, and then you just see a move which would have stopped traders out, and then you see another move higher, right? So hard in, hard out. Or you might see something like this, where you see price do something like this, right? An obvious range, right? And then you see something like that, and then you that, and then you see traders to the underside get in, and then it goes like that. That is what you would call a stop hunt, right? And it's because banks know where the liquidity is. They want to be buyers, right? So they're buying at an even cheaper price, stopping these guys out, solving their liquidity crisis, or say crisis, but their liquidity problem before pushing the market in the direction that they want, because they've done all of their accumulation, right? This is what you would call the accumulation phase, ranging market, etc. They can hide their iceberg orders. They know where the liquidity is because, you know, where traders place their stop losses are obvious. So again, price, you see something like this happen and you see hard in, hard out, or you see a move that, you know, does something like this, retraces back, fails to follow through to the downside, fails to follow through, and then starts to reverse on them. That's where you want to look for entries to try and get long, right? And that is how to trade ranges. Oh, sorry, my trackpad is all over the place. Trade ranges effectively, and that's how I look to trade ranges. And what we're going to do is we're going to look at a euro dollar example, and don't know if I'll cover the stop hunt. I might do it in maybe another video, but I'll cover the euro dollar and how I really approach the euro dollar on a price chart when it comes to identifying ranges. Right, so we're on the euro dollar chart, and I'm going to go over what traders would have probably been looking at in real time. So we've got a market in a downtrend, and I'm going to do a replay from somewhere like here, right? So this was clear to everybody, for everyone to see at the time. So one of the things you have to remember is that when you have, you know, price discovery, at some point you're going to have price acceptance, right? A ranging market. So we don't know where price is going to range from, but what I do know is that it should range from some supply zone, right? Daily supply. So we mark out supply zones, supply zones, supply zones, right? So I'm expecting price to range, I'll probably do that here, from one of these areas after trending for, you know, maybe a month or two, right? But we don't know where. But I have to obviously assume that I want to be a buyer of the dollar, and I don't want to be a buyer of the euro. So as we go forward, right, I'm expecting prices to range from, and I'll bring my range tool, one sec, sorry. I'm expecting prices to range between here and here. Right, now do I know if prices are going to range between this supply zone and this demand zone? Right, demand zone being down here, right? No, right? But I have to take the trade on an intraday time frame. I'm not taking it on the daily. I use daily as my analysis, my higher time frame analysis, and then I'll go down into a lower time frame to look for any trade entries, right? So this is what I'm expecting to happen. Price to range between this 1.17 level and this 1.15, 200 pips. And if I'm right, and I manage to pick off, you know, the somewhere around the highs, then I have at least 150, 200 pips to the downside. So we continue going forward. Prices don't range from there. Fine. Now I'm expecting prices to range from here. Right? So now I'm expecting prices to range between here and here. And again, doesn't matter if you lose that trade, that one trade, it's only one trade, all right? This now would be the area to look for short trades. Does this work out? Yes, right? Depending on obviously where you put your stop and whatever it is. So I'm expecting now price to range between this low and this high. And as we continue, prices now look like they're in this range, this choppy range. So now we've defined, and like I said before, remember, we're looking to get in first before everybody else gets in. This is where we're looking to get in. So the highs and the lows are where you want to be trading on a higher time frame. It might take a few weeks to get there, so be it. What you're doing is you're taking quality in the best trades. Right? We're not looking at, trading activity. So prices are, contained between this low and this high until something happens fundamentally or sentiment wise. So then we get what would be known as a breakout, and prices are now in price discovery mode. Once this happened, and let me just delete some of this stuff off. Now where am I looking for prices to range from? Has to be either here, or it has to be, we would have moved the supply zone from here to here, and then this would have been another one right here. So this is where I'm looking at prices looking to range. So as prices go forward, right, I'm looking for a ranging market between that high and that low. Does it work? No. No matter. So now I'm looking for a range between this high and this low. I'm looking for prices to do something like this. Yeah, something like that anyway. Does it work? The price into a range. Right, came down to the fair value. Now, that would have been probably enough pips anyway if you were maybe around about 250 pips, on a lower time frame chart. So decent amount of pips to go to the downside. We break out to the high side. Now I'm looking for a range between this high and this low. And again, fundamentals, understanding what you should be buying and what you shouldn't be buying, right, where value is, etc. And then we go forth. Yeah, so prices then range and now between this high, this low, and fair value, and so on and so forth. So we're always trying to trade at highs and lows. On a daily time frame chart, that's just me personally. I don't look at market state on lower time frame charts. I'm a swing trader, and that's exactly what I do. So if that helps and you want to know more about supply and demand and really picking the best levels of supply and demand, because there's a lot more that goes into just trading supply and demand. There's odds enhancers that you can use, 4 odds enhancers that you can use that really will increase the chances. Plus you've got your fundamentals. Plus we got something called capture pain relief zones, which are also included and analyzed within supply zones, which do increase your chances of a successful trade. So if you want to know a bit more, go to the Trading 180 website. Like, subscribe, share if you found this content useful as well. And David, I hope you found this useful, and I hope it does answer your question. If anyone does have any questions regarding anything to do with trading supply and demand, and it is, please do a question that isn't so vague, if you know what I mean. Don't say how to trade supply and demand, because that can cover anything. Be more specific. I think the next one I've got is higher time frame analysis and how I go over, how I approach time frame analysis. I've gone over a bit here, but I will go over it in a bit more detail in the next segment. So I would say next segment, but next video. But yeah, hopefully you enjoyed that, and guys, take care.